$600,000. That's what it took to buy the Henderson place outright. The bank manager smiled when the old man said he wouldn't be needing financing. "Everybody needs financing," he said, not unkindly, more like he was talking to someone who didn't understand how the world worked anymore. The old man just set his hat on the counter and started counting. This was March of 2009. The lobby of that bank in West Central Indiana had 4 other people waiting that morning. 2 of them there about loan extensions, 1 about a payment they'd missed, 1 young farmer trying to refinance equipment he should never have bought. The manager, a man named Philip Garrett, had been doing this job for 11 years. He'd seen plenty of farmers walk through that door. He'd never seen one walk in carrying a duffel bag instead of a loan application. Spencer Cooper, the man who made this decision. His name was Donald Wilson. And here's what happened and what it took and why nobody who watched it happen ever forgot it. I farm about 60 miles from Donald, different county, same kind of dirt. I didn't know him well back then, just well enough to nod at him at the co-op, well enough to know his reputation. And by 2009, Donald Wilson had a reputation. Some men called him disciplined. Some called him stubborn. A few, especially in the boom years, called him something less kind. Scared, behind the times. A man who didn't understand what was happening right in front of him. Turned out he understood it better than any of them. Donald was born in 1943. Raised on 320 acres, his father had homesteaded back when Indiana corn ground still came cheap, and a man could build something with patience instead of leverage. By 2009, Donald was 66 years old, his hands thick and permanently bent from decades of wrenches and steering wheels. His face the kind of weather that comes from 40 Indiana summers spent without much shade. He farmed 740 acres, corn and soybeans mostly. With about 60 acres of pasture, he kept for a small cow-calf herd more out of habit than profit. 740 acres put him in an odd spot in the 2000s. Too big to be called a hobby. Too small to be called serious by the men who were buying 3,000 and 4,000 acres at a clip. Squeezed, some called it. Donald never called it that. He called it exactly what it was. Enough to understand why Donald counting cash in a bank lobby mattered. You ever understand what was happening around him in those years? Because what happened to Donald can't be separated from what happened to nearly every farmer in the Corn Belt during this decade. This was a decade farming changed size for good. From 2000 to about 2005, things moved slow, steady, unremarkable. Corn traded mostly in that $2 range, sometimes touching $3. Land in Indiana crept up gradually. Nothing that would have alarmed anyone who remembered the 1980s. Donald farmed his ground, paid his bills, put a little aside every year the way his father taught him, and watched his neighbors do roughly the same thing. Then 2006 happened, and 2007. And by 2008, the entire shape of American agriculture had changed in ways that still get argued about today. 2 things collided to cause it. First, ethanol. Congress had passed a renewable fuel standard back in 2005, and then expanded it significantly in late 2007, a law that essentially guaranteed a market for corn that hadn't existed before, mandating that refiners blend growing amounts of renewable fuel into the gasoline supply, year after year, whether the market wanted it or not. Ethanol plants went up across the Corn Belt like nobody had seen before. Indiana alone had 9 of them running by the end of 2008, with 2 more under construction, together capable of using up nearly a third of the entire state's corn crop, a number that sat at about 4% of the crop just 3 years earlier. That's not a gradual shift. That's a structural change in who's buying your corn and how much they need. Second, and this one took most farmers longer to understand, China. Chinese demand for soybeans, for feed grains to support a rapidly growing domestic meat industry, was climbing in a way that fundamentally altered global trade flows. Add a weak dollar, add investors moving money into commodities as a hedge after years of stagnant stock returns, and you had what people in the business started calling a commodity supercycle. Not a good year, not a good run, a supercycle. The kind of multi-year structural shift that happens maybe once in a generation. Corn, which had spent years trading in the $2 to $3 range, climbed past $4 in 2007, climbed past $5 in early 2008. By the 3rd week of June 2008, with flooding across Iowa pulling supply concerns into a market already running hot. Corn touched $7.50 a bushel on the trading floor, an all-time high that nobody farming in 2005 would have believed if you told them. Soybeans followed a similar arc, climbing well past $15 at their peak. Wheat did something similar. For about 18 months, from late 2006 through mid-2008, it looked like every input a farmer had ever complained about, land, time, debt, was about to pay off bigger than it ever had. And land prices followed the grain prices up the way they always do. Indiana farmland values, which had been climbing in that slow, unremarkable way through the early 2000s, jumped sharply. By June of 2008, average quality Indiana farmland had increased roughly 15% over the previous 12 months alone, and that was on top of gains in the years before it. Good ground in the western part of the state, the kind Donald and his neighbors farmed, was trading in a range that would have seemed fictional in 1999. Donald watched all of it happen, and Donald, by his own account later, almost did something about it. That's the part of the story most people never heard, because Donald never told it loudly. There was a stretch in early 2007, corn climbing, ethanol plants going up, neighbors expanding, when Donald drove 40 minutes to look at tract of ground that had come up for sale. 210 acres, decent dirt, adjoining a farm 3 miles from his own. He sat in the truck outside the field for the better part of 20 minutes. He had the banker's number in his coat pocket. He'd even mentioned it to his wife, Carol, the night before, mentioned it the way a man mentions something he's already have decided to do. What stopped him wasn't fear, and it wasn't poverty. He had the operating capacity to make a case for that loan, same as anybody. What stopped him was arithmetic he'd learned the hard way, decades earlier, watching his own father survive the late 1970s boom and the early 1980s collapse that followed it. His father used to say something to him when Donald was young, something Donald repeated more than once over the years. Land pays for itself in about 15 years of good farming, if you're patient and the prices hold. Not 5 years, not at the top of a boom. 15 years, assuming nothing went wrong. Sitting outside that field in 2007, Donald ran the numbers in his head the way his father had taught him, at the prices being asked. With corn riding high, but no guarantee it would stay there, the math only worked if every year going forward was a good year. Perfect yields, perfect prices, no drought, no flood, no crash. 15 years straight, without a bad one. He'd seen that bet before. He'd watched his own father's neighbors make exactly that bet in 1978, certain that 7% land appreciation was simply how the world worked now, certain that grain prices only moved in one direction. He was 11 years old when it started and 17 when half those neighbors lost their farms. He didn't need to relearn that lesson. He'd already paid for it once, just by being there to watch. He drove home without calling the banker. That decision, quiet, private, made alone in a truck cab, is the real beginning of the story. Everything that came after, the bank lobby, the $600,000, Philip Garrett's laugh. None of it happens without that 20 minutes Donald spent doing arithmetic instead of getting swept up in what everybody around him was doing. Because everybody around him was doing it. That's the part that made Donald's choice harder than it sounds now, with hindsight sitting in our laps like an answer key. In 2007 and into 2008, expansion wasn't the exception in West Central Indiana. It was the expectation. Coffee shop talk wasn't about whether to grow. It was about how fast. Donald's neighbor to the east, a man named Phil Henderson, 61 years old in 2008, a third-generation farmer on land his grandfather had cleared, was one of the men moving fastest. Henderson farmed about 900 acres going into the boom, comparable in scale to plenty of operations in the area. But Henderson believed, the way a lot of good men believed in those years, that this was finally the moment the math changed for good, the moment a man who farmed conservatively his whole life could finally get ahead instead of just getting by. In the spring of 2007, Henderson bought 240 acres adjoining his home farm, financed at land prices that already looked aggressive at the time and looked worse with every season that followed. That same year, he traded into new equipment to handle the larger acreage, a track tractor in the 400-plus horsepower range. The kind of machine that cost more than Henderson's entire farm had been worth when his father ran it and a new combine to match it, both financed, both built into the same operating note that now also carried the land purchase. I want to be careful here, because this part of the story gets told wrong more often than it gets told right. Henderson wasn't reckless. He wasn't foolish. He was a good farmer who made a rational bet based on the information in front of him. Corn at record highs, ethanol demand structurally locked in by federal law. Every banker in the county eager to write the loan, every agricultural economist in every farm magazine, saying this time the fundamentals really had changed. Henderson did the math too. He just did it with different assumptions than Donald did. Assumptions that looked entirely reasonable in 2007 and looked like a trap by 2009. That's the part of this decade that doesn't get talked about enough. The men who expanded weren't the foolish ones, and the men who held back weren't the wise ones. Not really. Not in any way you could have proven at the time. They were both making bets. One bet happened to be right. Donald kept farming his 740 acres through 2007 and into 2008, watching corn climb past $6, past $7, watching land values jump again that summer, watching Henderson and a half dozen other neighbors lease more ground, finance more iron, push harder into the boom, at the elevator, at the implement dealer. Even at church on Sundays, Donald heard the same question in different forms. Why aren't you expanding? Don't you see what's happening? His wife, Carol, used to say he'd just nod and change the subject. He wasn't trying to convince anybody of anything. He genuinely didn't think it was his place to tell another man how to run his farm. He just knew what he was and wasn't willing to risk on his own ground. And he kept his 740 acres debt-free the way he kept it for the better part of 2 decades, paying cash for what he could afford and doing without what he couldn't. There's an old habit Donald had that became part of how the story ends. And it's worth explaining now because it matters later. Every year, after harvest, after the bills were paid and the operating note, what little of it existed, was settled, Donald set aside whatever was left, not invested in the stock market, not poured into more land or bigger equipment. He kept it liquid in a savings account at the same small bank in town, year after year, the way his father had taught him to think about money. A farm has good years and bad years, and the good years are what get you through the bad ones if you let them. By 2008, after more than a decade of disciplined saving and several genuinely excellent crop years riding the early edge of the commodity boom, Donald sold his 2007 and 2008 corn at prices his father never lived to see. That account held more money than Donald had ever had sitting in one place in his life. He wasn't trying to build it for any specific purpose. He just kept doing what he'd always done. Say what you don't need. Spend less than you make. Never borrow what you can't pay back from this year's crop alone. Then came the fall of 2008. This part of the story isn't really about farming. Not at first. It's about Wall Street. In September of 2008, Lehman Brothers collapsed. The stock market entered a free fall that wiped out trillions in value over the following months. Credit markets seized up almost overnight. Banks that had been eager to lend on anything with 4 wheels or 400 acres suddenly weren't lending on much of anything. The country was sliding into what would come to be called the Great Recession, the worst economic downturn since the 1930s. Agriculture wasn't immune to it, even though for a few months it looked like it might be. Corn had already started sliding from its June peak before Lehman even collapsed. Partly normal harvest pressure, partly the first signs that the super cycle was cooling. But what happened that fall accelerated everything. Crude oil, which had been trading well above $100 a barrel and dragging ethanol demand and corn prices up behind it, collapsed along with the rest of the commodity complex. By December 2008, with oil down around $45 a barrel, corn had fallen all the way to roughly $3.09 a bushel, less than half of where it stood that June. A fall of that speed in a market that size is not a correction. It's a trapdoor for a farmer like Henderson, leveraged into new land at boom prices, carrying a loan on equipment sized for an operation he just expanded into, banking on corn holding somewhere near $6 or $7 to make the new math work. The floor didn't just shift, it disappeared. I want to walk through what that actually meant in dollars, because the scale of it is the whole point. Henderson had financed 240 acres at boom era prices, on top of his existing land payment. He financed a tractor in the 400-plus horsepower range and a new combine, both priced in the high five and low six figures. Both bought on the assumption that high commodity prices would carry the payments comfortably. When corn fell from $7 to $3, his projected revenue on that newly expanded ground didn't drop by a little. It dropped by more than half, landing right in the same season his note payments were calculated against the old, optimistic numbers. Through 2009, credit tightened across the board as banks, badly burned by the broader financial crisis, grew far more cautious about agricultural lending. Exactly when farmers like Henderson needed flexibility the most. The note Henderson had signed in the flush days of 2007 didn't care that the world had changed. It still wanted its payment, calculated against revenue that no longer existed. By the late winter of 2009, Henderson was sitting at his kitchen table doing arithmetic that had nothing good in it. He'd talked to his banker, not the friendly version of that conversation he'd had in 2007, but a different kind of conversation, the kind where words like restructure and workout and additional collateral start showing up. He had 2 sons, neither of them farming, both with steady jobs in Indianapolis, neither in any position or any inclination come home and absorb a debt load that size. Henderson was 61 years old. He did not want to spend what was left of his working life fighting a note that had stopped making sense the moment corn crossed back under $4. He started quietly asking around about selling. Not the whole operation, just the 240 acres he'd bought at the top, the piece that was strangling the rest of his farm. He needed it gone, and he needed it gone in a way that would actually clear the debt attached to it, which at boom-era financing meant he needed something close to what he'd paid, even with the market down. That's when the corporate buyers started circling. Word travels fast in farm country when ground might be available, and by 2009, there were investment groups, agricultural REITs, institutional buyers, a couple of out-of-state operations with money to deploy, and an appetite for Corn Belt land at what they correctly read as a temporary discount, actively working the area, looking exactly for situations like Henderson's. A representative from one such group met with Henderson twice that winter. The offer was professional, the numbers were defensible, and the timeline was tight, the kind of close-fast, ask-no-questions deal that institutional money tends to bring to a table. It would have solved Henderson's immediate problem. It also would have meant ground his grandfather cleared by hand going into a portfolio managed from an office 3 states away, worked from then on by hired operators, answering to people who would never set foot on it. Henderson, by his own later account, hated the idea more than he expected to. He'd told himself going into the boom that land was just an asset, a number on a balance sheet like anything else. Sitting across the table from a polite young man in a sport coat explaining acquisition timelines, he realized that wasn't true, hadn't ever been true. It just hadn't mattered until the alternative became real. That's roughly where things stood in late February of 2009 when Donald Wilson heard about it. Not from Henderson directly at first, but from a mutual acquaintance at the grain elevator. The way most things get known in a farming community before anybody officially says them out loud. Donald didn't go to Henderson with an offer right away. That wasn't how Donald operated, and it wasn't how 2 proud men in that part of Indiana operated with each other either. Instead, a few days later, he drove over on the pretense of asking about a piece of equipment Henderson had for sale, and the conversation worked its way around, the way these conversations do, to what Henderson was actually facing. Henderson laid it out plainly, because by that point there wasn't much use pretending otherwise to a neighbor he'd known his whole life. The 240 acres, bought at the top, now needed to come off his books before it dragged the rest of the farm down with it. He had an offer from the investment group. It wasn't a bad offer, dollar for dollar. It just wasn't the kind of offer that let him sleep well at night. Donald asked him a single question before he left that day. Would Henderson rather sell to him if the price could be made to work? Henderson's answer, by every account of that conversation, was immediate. Of course he would. But Henderson also told him straight, Donald would need to move fast, and he'd need to move with real money, because the corporate buyer's timeline wasn't going to wait around for financing to clear. That night, Donald sat at his own kitchen table with Carol and did the kind of arithmetic he'd spent more than a decade preparing for without quite knowing it. 240 acres, at a price that would let Henderson clear his obligation and walk away clean, came to almost exactly $600,000, a number that, in the deflated post-crash market of early 2009 represented something close to fair value for good Indiana ground, even if it would have looked aggressive against the depressed prices some panic sellers were taking that same season. Donald had it, almost to the dollar, sitting in that savings account at the bank in town. More than a decade of disciplined saving, several outstanding crop years near the front edge of boom, and not one year of reckless borrowing standing between him and writing a check that size without flinching. There was a moment that night, Carol said later, when Donald sat quiet for a long while after running the numbers out loud. Not doubt, exactly. More like the weight of it landing on him. The fact that this very specific outcome, a neighbor's farm coming up for sale at a price he could meet without owing anybody anything, was a direct result of a decision he'd made alone in a truck cab 2 years earlier, a decision nobody else had understood at the time and several people had openly questioned. He didn't say much about that. He just told Carol he was going to the bank in the morning. Which brings us back to where this story started. Donald Wilson walking into that small-town Indiana bank on a March morning in 2009, dressed exactly the way he dressed every other day of his life, work boots and a canvas coat that had seen 15 winters, carrying a duffel bag instead of a briefcase. Philip Garrett, the bank manager, didn't recognize him at first. Donald wasn't a regular at that particular branch, having banked mostly at the credit union in the next town over for years. When Donald told him what he was there for, paying out the Henderson parcel in full, no financing required, Garrett's first reaction was a laugh that opens his story. Not cruel. Garrett would later say, just genuine surprise, the reflexive reaction of a man whose entire working world in 2009 consisted of farmers who needed money, not farmers who had it. Everybody needs financing, Garrett said. He'd said some version of that sentence to a dozen farmers that month alone, men sitting across his desk asking for extensions, restructures, anything that would buy them another season. Donald didn't argue with him. He set his hat on the counter, unzipped the duffel bag, and started counting out cash in a cashier's check together, a stack of bills he'd been building toward, without ever quite naming the purpose, for more than 10 years. It took a while, long enough that the other people waiting in that lobby noticed. Long enough that Garrett, by his own later telling, stopped halfway through processing it and just watched for a moment, doing the kind of recalculating a man does when something he believed about the world turns out to be smaller than reality. The sale closed within the week. Henderson got his number, cleared the debt that had been strangling him, and kept the rest of his original farm, the part he hadn't overextended on, debt-free and his own. He didn't get rich off it. He got out from under it, which by that point was worth more to him than Rich would have been, the corporate buyer's representative. According to the same mutual acquaintance who'd first mentioned all this to Donald, call Henderson once more after the deal closed, apparently unaware it had already gone through to a neighbor. Henderson told him the ground wasn't available anymore. He didn't elaborate. Donald, for his part, didn't throw a party or make any announcement. He simply added 240 acres to his operation, bringing him to 980 acres total. Still well under the scale of the men who'd expanded aggressively through the boom, still entirely debt-free. He farmed it the next spring the same way he farmed everything else. Carefully, without urgency, the way a man farms ground he intends to still own in 20 years. I think about what almost happened. Sometimes, when I think about this story, Donald almost bought that other tract back in 2007, at the top, on borrowed money, the same way Henderson did. If he had, there's a real chance he'd have been the one sitting across from a polite young man in a sport coat in the winter of 2009, not the one writing the check. The difference between those two outcomes wasn't talent, and it wasn't luck in the way people usually mean that word. It was 15 minutes Donald spent doing arithmetic his father taught him, on a day when almost everyone else in the county had decided that kind of arithmetic no longer applied. That's the part of this decade I keep coming back to. Timing is everything in farming, more than people who've never done it tend to understand. Not just timing the weather or the markets or planting around a wet spring. Timing when to push and when to wait. Donald wasn't right because he was smarter than Henderson. He was right because he was patient at the specific moment patience mattered most. And Henderson was confident at the specific moment confidence turned out to be expensive. Different men, similar character, opposite outcomes, separated by about 18 months and one collapsed market. If you want to share where you're watching from, drop a comment. I always like seeing how far these stories travel. I'll tell you something else about Donald, something that has nothing to do with money. By 2009, he was 66 years old, and the work had started catching up with him in ways that had nothing to do with his bank account. There was a stretch that same winter, right around the time all this was happening with Henderson, when Donald started having real trouble in the mornings, not from the stress of it, just from being 66 years old and having spent 50 years of those years doing physical work most men quit decades earlier. He told me about it himself a couple years later when our paths crossed at a farm equipment auction and got a talking. Said he'd get out of bed and just stand there some mornings, waiting for his knees and his lower back to remember how to work before he could make it down the stairs. Told himself for a long time that's just what it meant to get old doing this kind of work. Figured everybody his age dealt with the same thing and didn't talk about it much. Same as he didn't. What changed it for him was a neighbor of his, not Henderson. A different fellow, a man in his early 70s who was still out there every single day running his own operation without much slowing down at all. Donald asked him once, half joking, how he managed to still move like that at his age. The man told him straight. It wasn't really about age at all. Said there's a fluid inside your joints that's supposed to keep everything moving smooth, and that fluid breaks down over the years, especially in men who spent their whole lives doing real physical work. Most doctors never mention it, but you can do something about it. That neighbor pointed Donald towards something called joint genesis. Donald was skeptical. He'd say, so himself. Told me he'd tried a few things over the years that didn't amount to much, but he gave a real try, the full 6 weeks or so it apparently takes to actually feel a difference. He told me what changed it for him was a Sunday morning that spring. Carol called down for him from the kitchen, and Donald realized halfway across the house that he walked the whole way without stopping once to brace himself on a door frame or a chair back. Something he'd been doing, without even noticing for months by that point. Didn't think much of it in the moment, just kept walking. It was only later that day, sitting at the table, that it actually struck him how long it had been since his body just did what he asked it to do, without negotiating first. If that sounds familiar to you, those mornings where you're waiting for your own body to catch up before the day can start, it might be worth looking into. It's easy enough to find. Right below this video, there's a description, and if you scroll down just a little, you'll see the very first link in it. It'll say, click here. That's the one. I'm just passing along what Donald passed along to me. Same way that neighbor passed it along to him. Now, back to the rest of what happened. The years that followed told the bigger story of that decade almost as clearly as Donald and Henderson's did individually. Across that same stretch of West Central Indiana, and across the wider Corn Belt, the consolidation that had been building all decade kept right on building, recession or no recession. Farms that had over-leveraged during the 2006 to 2008 run either restructured under real pressure, sold pieces of themselves the way Henderson did, or in the harder cases sold out entirely. Farms that had stayed conservative, the way Donald had, often found themselves in position to pick up that ground when it came available. Sometimes from neighbors, sometimes through banks working out distress notes, sometimes, like Donald, simply because they had cash sitting in an account at exactly the moment cash mattered most. It wasn't a clean morality tale, even though it can sound like one in the retelling. Plenty of men who expanded aggressively in the boom years made it through just fine. Corn prices recovered through 2010 and into the years after, climbing back above $6 and staying elevated for a long stretch. An operation that had simply expanded a year or two earlier or later than Henderson, or financed on slightly different terms, came out the other side standing strong. Henderson himself wasn't ruined. He kept farming the rest of his ground for years afterward, debt-free on what remained, by his own account more at peace with a smaller operation than he'd ever expected to be. There's no neat lesson here that says debt is always wrong and patience is always right. There's just this one specific story about one specific 18-month window where one man's caution and another man's confidence landed on opposite sides of a market that turned faster than almost anybody saw coming. What I keep coming back to, though, is what that bank lobby looked like that March morning in 2009. A 66-year-old man in a canvas coat, setting his hat on the counter, counting out $600,000, while a room full of people who needed loans watched him do it. Not because he'd gotten lucky, Because for more than a decade, year after unremarkable year, while plenty louder men around him were betting bigger and moving faster, Donald Wilson had just kept doing the same quiet thing his father taught him to do. Spend less than you make. Say what you don't need. Never sign for anything the crop in front of you can't pay back on its own.
It isn't a flashy way to farm. It never made anybody famous at the co-op. But it meant that when the moment came, and in farming, the moment always comes, sooner or later, for everybody, Donald Wilson was the one holding the duffel bag instead of the one across the desk asking for more time. If you grew up on a farm that isn't farming anymore, I'd like to know when it ended. Tell me in the comments. These stories matter to me, and I think they matter to a lot of you too. I'll see you in the next one.